The Stagflation Playbook is getting a fresh look ahead of the upcoming CPI data release, with market participants eager to gauge inflationary pressures in the US economy. Recent economic indicators have pointed to a slowdown in growth, sparking concerns about the potential for stagflation, a rare phenomenon where inflation rises despite stagnant or declining economic activity. Several key catalysts are driving this renewed interest in the stagflation playbook. The first is the recent decline in GDP growth rates, which has raised questions about the sustainability of the current expansion. Additionally, rising inflationary pressures, as measured by the Consumer Price Index (CPI) and Producer Price Index (PPI), have sparked concerns that policymakers may need to intervene to mitigate these effects. The upcoming CPI data release will be a crucial test for market participants looking to gauge inflationary trends in the US economy. Market expectations suggest a modest increase in CPI, with forecasts pointing to a 0.2-0.3% month over month rise. However, any deviation from these expectations could have significant implications for interest rates and overall economic sentiment. The scenarios for the stagflation playbook are numerous, but they can be broadly categorized into three main camps: inflationary, deflationary, and neutral. In an inflationary scenario where CPI exceeds market expectations, bonds would likely sell off, pushing up yields and interest rates. Conversely, a deflationary scenario where CPI falls short of expectations could lead to a decline in bond prices and a corresponding increase in interest rates. In the event that the CPI data release fails to meet market expectations, it is likely that policymakers will take a more hawkish stance on monetary policy, leading to higher interest rates. This could have significant implications for the overall economy, potentially slowing down growth and exacerbating inflationary pressures. A key risk to consider is the potential for unexpected shifts in economic fundamentals, which could invalidate any existing strategies or predictions based on the stagflation playbook. For example, a surprise change in fiscal policy or an unexpected drop in oil prices could rapidly shift market sentiment and undermine any carefully crafted trading strategy. Despite these risks, there are several tactical ideas that traders can consider ahead of the CPI data release. One possibility is to focus on interest rate sensitive assets, such as treasuries, mortgage backed securities, MBS, and other fixed income instruments, which would likely react strongly to changes in interest rates. Another option could be to look for opportunities in inflation linked assets, such as treasury, inflation protected securities, TIPS, or commodities like gold and oil. The takeaway from this scenario is clear. The stagflation playbook is a high stakes, high reward proposition that requires careful consideration of market trends and economic fundamentals. As traders prepare to navigate the uncertain landscape ahead of the CPI data release, they would do well to remain nimble and adaptable, ready to adjust their strategies on the fly in response to any unexpected twists or turns.